G'day everyone, and welcome to another one of our live InvestSMART Q&As with myself, Mitchell Sneddon. I'm the Head of Portfolio Services here at InvestSMART. And this afternoon, we're going to be talking about getting the investment ball rolling. And what I mean by that title is starting investing for perhaps yourself if you're maybe in your early 20s or 30s and you're starting to look to put some funds aside to actually get invested in the market. Or if you've got children or grandchildren that you're wanting to give a good leg up to and open up an account and get them investing and let time and compounding interest take care of the rest. The reason why I thought this topic is quite relevant at the moment, we've actually had a number of our clients who have got separately managed accounts with us actually contact us and start opening up accounts for their grandchildren and children. So with a few more of those coming through, I thought we'd go through the ins and outs of that process and of course, what are the right investment options when you are setting something up for the real long term. Now, of course, my very first slide, if you've ever watched a webcast of ours before, is always my most important, and that's our disclaimer. Now, I'm going to be talking about general investment themes here. I will be also answering your questions, so we may talk about some stocks in that process as well. But as well as, especially today, because we're looking at a couple of different ways that you can structure investments for minors, there are some tax consequences. So please always, before looking at doing that, consult your accountant and/or financial planner. Now, so I might, as I said, this is general investment advice only. So I can't take into consideration any of your personal circumstances, especially when we do get to the questions section. Now, that's a reminder, we do have questions. You can ask them as we're going along. At the end of my formal presentation, I'll duck back to the questions and then be able to cover off anything that we may not have been able to answer during the actual presentation itself. So just below the video box there on your computer, you will see a little space where you can enter your username and then enter the question and hit send, and that'll come through to us here, and I'll be able to look at those once I've finished the formal part of the presentation. So going on to my very first slide after the disclaimer here, I'm dividing this presentation up into two segments. So firstly, the investment structure is in how you should actually, what you should invest in for the longer term and what are the suitable investments for that. The second half of the presentation, I'll go into the actual how you should structure something for a minor if you're investing on behalf of them or wanting to set something up. So from a recent ASX study, it's actually come out that more and more younger people are investing. So over the last 5 years, 18 to 24-year-olds has actually doubled from 10% to 20%, which is fantastic to see. 25 to 34-year-olds, they've increased as well from 24% to 39% over those last 5 years. That's the category that I fit in there. Now, the interesting part of it here is that despite these younger people investing, more and more of them are actually far more conservative about their investing, and that tells me that perhaps the wrong investment message is getting out there when they are looking at setting up their initial investments. 81% of investors under the age of 35 are actually looking for capital stable returns. It's interesting, I didn't put it in here, but in the actual ASX study as well, when they looked at what are the acceptable returns for investors in this actual age bracket, they wanted stable, consistent returns, but they actually were seeking 8% plus. The issue with that there, especially if you're been an investor at home for quite a long time, is you know that you cannot get 8% from any type of guaranteed product. So, term deposits or bonds, etc. That's just not appropriate return for those asset classes. So these people are expecting higher growth asset class returns, but they're hoping to get it in a capital stable type of environment. So it's quite a juxtaposition there. It's just not appropriate. And so I think maybe there's a lack of education there with the younger investors that are coming on board. And so when I think about investing and how my personal investments are structured as well, because I do have a long investment horizon here, I'm more, my asset allocation is more leaning towards the growth investments. So that's Australian equities and international equities and property. So they're the three growth investments. Now, if we go onto the next slide here and we look at, and what I've just titled this one is a longer time horizon, the more growth assets, just like I said. So you can see on the left-hand side, I've got a conservative portfolio, and on the right-hand side, I've got our high growth settings. So if you were using the InvestSMART Portfolio Manager tool and you went into select your investment goal, and you selected the conservative, this is what you would get on, this was the asset allocation as chosen by our investment committee for a conservative portfolio. And on the right, it's our asset allocation that's chosen for a high growth investor. So a high growth investor is someone with 10 years plus outlook on the market. The conservative portfolio is 0 to 2 years. So as you can imagine, with a conservative portfolio, it's much more weighted towards cash and fixed interest, and far less weighted to international equities and Australian equities. Whereas our high growth portfolio, you can see it's heavily weighted to Australian equities, international equities, and those exposure to cash and fixed interest are quite a bit lower. And the reason for that is because you've got a longer time horizon. You can recover from the ebbs and flows of those equity markets. So you can recover through market corrections a lot, and because we've got that time period to do so, whereas a conservative portfolio doesn't have that time period. So they need to have more exposure to those capital guaranteed and capital stable investments. So another, and when looking at that high growth setting, you might notice in our investment options, we actually don't have a high growth diversified portfolio. But if you, on this next slide here, I've just stated that you can actually achieve that 10-year high growth setting by actually choosing the InvestSMART core growth portfolio and then actually adding 20% of the InvestSMART international equities portfolio. And that'll actually match up with that high growth setting for those wondering how you actually do achieve it using what we've got on the website there. So this next slide here, the ASX, the year to date, gives you an example that over the shorter period of time, the markets can be quite erratic. And so hence why that you don't want too much exposure to them if you do have a shorter time period when it comes to investing. Because in the short term, who knows what can actually happen over those investment cycles. Now, and when we go out over to the next slide here, to the long-term ASX returns, you can see that despite the GFC, which is quite obvious in the middle there, the market has had over the very long term, so this is going back from 1993 through to today, you can see that the ASX, and this is not including dividend payments, you can see that the ASX has got very much a trend in the positive direction. So over the long term, the market will generally goes up close to about 7 to 8% per annum. In the short term, though, you're just not too sure what is actually going to happen. So, but over the long term, we do know that generally speaking, we're going to have more positive years than negative years from our equities, and that's why younger investors really should be more concentrated on Australian equities, international equities, and property. So those three growth asset classes, and far less on cash and fixed interest, okay? Because over the long term, those three property classes, even with market corrections and the odd occasional crash, will still outperform those other asset classes over the long term. And that's what you're doing if you are investing for a newborn child and they're not even 1 year old yet, and you've got and in time you're going to hand over the portfolio to them when they're 18 years old. You've got 18 years of investing ahead of you, so you really should have it set to that higher growth asset class instead of something like a balanced or a conservative asset class. So moving on now to what are the actual suitable structures for investing, either for yourself if you're younger and just starting out your investment journey, or you're investing on behalf of a minor. For me, one thing that I do look for when it comes to investing for the long term is I want low maintenance. Okay, so when I'm looking here at low maintenance, I think of four classes of potential investment. I think managed funds, something that I can just send off an application form for and then just have the dividends being reinvested. Separately managed accounts, similar to managed funds, of course, but with a bit more transparency for you there. Exchange traded funds, if you don't want to take advantage of a stock picking managed fund approach, you can invest in an exchange traded fund and just get the index return, which is what we were looking at just before. And that's where you actually have that direct share ownership as well. You also, though, have that with the separately managed account side of things. And then listed investment companies, that's another approach where you can get access to an active portfolio manager, so a fund manager picking stocks for you there, but it's listed on the market. And so all four of these come with their advantages and disadvantages. But if you are looking to set up something for a child or for yourself, where you can just pull it out of the bottom drawer every 6 months or so and maybe add to it in time, then one of these four structures are probably going to fit the bill for you. Now, things to consider before actually selecting one of those four structures. How hands-on do you actually want to be? Now, I would say if you don't want to be hands-on at all and you just want to literally buy and set and forget and maybe add to your investment once a year or once every 6 months, and then perhaps either exchange traded funds, managed funds, or a separately managed account is right for you. That's something that all three of those things are something that you can invest in, have set up, and then if you've got faith and confidence, of course, in the manager, simply forget. Managed funds and separately managed accounts are very easy to add funds to in time. You can literally set up a regular contribution plan where funds come out of your account and into the either managed fund or separately managed account. Or in time you can just look to add to it as you've saved up a little bit of extra and pay via BPay into a lot of managed funds and separately managed accounts. They have that option available to you. With ETFs, you will have to purchase them on the market, so just keep in mind there that you will be incurring brokerage fees. Now, the second point here I've got is listed investment companies. Look, you will have to watch these closer. A number of them will, generally speaking, listed investment companies can and will trade below and above their actual values. So sometimes that can run quite considerably, and sometimes it can drop away to quite a considerable discount as well. If you want to get the most out of that type of investment structure, you are going to have to keep an eye on it. You might have to trim when it's expensive and maybe add to it when it's undervalued. And you need to keep an eye, of course, on the underlying management and what they're up to. Whereas with an exchange traded fund, of course, you're just going to get the index return that you've chosen. With a managed fund, the manager, it's always, the value of the portfolio is always going to reflect the underlying value of the assets held in that managed fund. With a separately managed account as well, you get the exact same as a managed fund, where your holdings, your actual the value of your holdings are the actual value of your portfolio, whereas a listed investment company can vary quite considerably to the underlying value. Sometimes it's a good thing, but sometimes it's also a bad thing. So then if you did want to go direct shares, they're much more hands-on than a managed fund or a separately managed account. So just keep that in mind. And then do you want to pay for potential outperformance? So that's the question you need to ask yourself if you're looking at, say, do I go into an exchange traded fund or do I go into a managed account or a separately managed account or a managed fund? If I go into an exchange traded fund, you know you will not be outperforming the market. An exchange traded fund will do what the market does, what the index does, its tracking does, minus the cost of its fees. So just keep that in mind, whereas you will never ever outperform. Whereas with a managed fund and a separately managed account with an active fund manager there, you have the chance to outperform, but you also have the chance to underperform the market as well. At the same time, if you do outperform, most funds out there have a performance fee involved, and so you will be paying additional fees, of course, because you're getting above and over the market return. So once again, something to keep in mind when you're selecting these longer term investment vehicles. The fifth one there, regular contributions. Is it easy to add more to? I think I covered that off at the start of this particular slide when I was saying with a managed fund and a separately managed account, typically with both of those things, you'll have a regular contribution plan in place that you can add to, say on a monthly basis, or you can add to it on an ad hoc basis. Generally speaking, with these two things, with a direct deposit or a BPay situation. Whereas a listed investment company and an exchange traded fund, you're going to have to go out there and purchase them on the market. When you're purchasing them on the market, you're going to incur brokerage fees. And depending on which broker you deal with, they can range from a couple of dollars to who knows what with a full service broker. So just keep that in mind when looking at selecting your actual investment vehicle. Now, once you've actually got it all set up and you're in for the long term, time is your big is your friend in this circumstance here. Because you're, say, investing for 18 years or more, you can really let those dividends that you get paid compound. So how you actually set up a dividend reinvestment plan, or a DRP, you might see them called. With direct shares, if you're holding an exchange traded fund or a listed investment company, you will need to you'll need to get in touch with the share registry that's associated with that LIC or ETF. How you do that is just go to the ASX website and you'll look up the stock code that you hold, and you'll be able to see there on their information page the share registry name. Now, typically, I think there's only three major ones in Australia. Computershare and Link Market Services are the most common, and Boardroom Proprietary Limited now is actually taking a bit of market share off them. It's a lot of companies are now starting to use them as well. Now, once you contact them, you just tell them that you want to set up a dividend reinvestment plan, and they'll help you out there. With a managed fund, typically the reinvestment option, or a separately managed account as well, typically the dividend reinvestment option is either a default setting, or there's a box to tick it when you are setting up the initial investment. If you haven't done that with a separately managed account or with a managed fund, then the best way to do that, of course, is to get in touch with the fund administrator, and they'll be able to help you out. It should just be a nice, simple, straightforward form. But so a dividend reinvestment plan is very handy for when you're looking to really compound, when you compound those returns over time, but also set up a truly set and forget style of investment approach for yourself or for someone else. Now, some people will choose to actually, and these people are going to be more hands-on, some people will choose to receive the dividends as cash into their transaction account, and then look to redeploy them when the timing's right. Now, some people choose not to use a dividend reinvestment plan because when you do use a dividend reinvestment plan, you are buying the stock when the manager tells you to buy it and at what price you're being told to buy it. So you don't have any choice. But if you wanted to take the dividends, especially if you are consistently adding to an account to deploy at a later date, if you're doing that, have the dividends get paid into the same account and then redeploy them when you want to buy it. So say if there's a pullback in the market and you're investing in exchange traded funds, you might want to add to it then. Or if it's a listed investment company, for example, and there's a pullback in it, or there's a disconnect between price and value, then you might want to add to that then. With a managed fund as well, though, if there's a pullback to the market and a separately managed account, you might want to add to those products then, rather than when the actual manager tells you to do so during the dividend reinvestment plan. So there's some options, but of course this option here is a little bit more hands-on. You need to look and keep an eye on things and redeploy when you want to and when you think there's an opportune time. Now, this brings us to our second part of the presentation. This is the actual things you need to know when it comes to setting up an account when you are investing for a minor. Now, with a child, minors under the age of 18 years old cannot invest personally in shares. So if you went to CommSec or E-Trade or NabTrade and tried to set up a personal account for someone under the age of 18, you couldn't do it. If you came to us to open up one of our separately managed accounts, we can't do it for someone under the age of 18. But you can buy shares on their behalf. So when you go to a broker or come to us, basically the simplest form to do it in is to set up the account, or the brokerage account, or our separately managed accounts, with yourself as trustee for then the minor's name. And so that will mean you're the actual owner of the shares, but the minor, when they turn 18 or whenever it is you decide, it could be after that, they will then become the legal actual owner. They're the beneficiary of that holding. So if you go to your online broking accounts, they'll all, the ones that I've looked at anyway, the major ones, they'll have the option there where you can set it up as yourself as trustee for, and then the minor's name. Now, you're not actually setting up a formal trust structure. It doesn't form a family trust or anything like that. It's just so that you can hold the shares, and then the minor becomes the beneficiary and the owner of them later on down the track. And so when that time does come, you'll then just have to transfer the stock or the managed fund, etc., into their name. Now, the next slide here, this is quite important, and I will put the disclaimer up here. This is just general information when it comes to the tax considerations, and do see your accountant or advisor to see what is best for your specific circumstances. But some tax considerations, because you can set this up in two different ways. One, you could put in your tax file number, so you're the owner and you pay the tax on behalf of the child. And then when they turn 18, of course, and maybe dispose of the shares, then they will have to pay the capital gains. You can also, though, set it up with the child's tax file number, so they have to pay the tax as you go along. And if you do that, well, you need to be aware of a few things. If a child earns more than $416, a tax return will need to be completed. Now, the tax-free threshold for a minor, we just said, is $416. From $417 to $1,307, the tax payable on that is 66%. Now, the reason for such a high tax bracket there is to stop parents from, say, and I'm sure none of you would ever do this, stop parents from hiding funds in their children's names. Income then over $1,308 has tax payable of 45%. So that's if you do it in the child's name, with the child using the child's tax file number. So they actually have to submit a tax return, and they have to pay that tax. Now, if you did it in your own name with your own tax file number, with the child as the beneficiary, then you just pay at your marginal tax rate. So that's just something to keep in mind there. And on this next little page here, I have actually gone through the majority of it. Now, two things to keep in mind, or one major thing to keep in mind when setting up the investment in your name with your tax file number, If you are on any social security benefits, etc., do make sure you go and seek out the advice from your accountant and or financial advisor. The reason for that is this could impact those. And also, if you have more than one child, you might have 2, 3, 4, it might be more advantageous for you to actually set up a family trust structure. Once again, though, I do recommend you go and speak with your accountant and speak with your financial advisor about doing it and tailor it to your specific circumstances. But the simplest, most easy, direct way to do it, if you wanted to do it this afternoon, then you just simply put in on an application form your name as trustee for, and then the child's name, and then that will be able to invest for them on that basis. Now, once again, I thought I'd just wrap this up here now, looking at the InvestSMART portfolio examples that you can use. So of our current portfolios, the ones that have a higher allocation to those growth assets that would be more appropriate for a long-term investment. I've got here the equity income portfolio. That is the Intelligent Investor Equity Income portfolio. And it's 100, well, almost 100%. It's about 95% Australian equities, handpicked by the Intelligent Investor investment team. Don't let the title of income fool you there. Yes, it is an income portfolio, but there is a lot of capital growth in that portfolio, or historically there has been. The reason for that is because first and foremost, before we invest in any stock from the Intelligent Investor side of things, we look for value. Okay, and if something's undervalued and then the market actually closes that gap to value, we're going to get a nice return from that. On top of that, we're then going to get the dividends as well. So the equity growth portfolio next to that here, this is also the Intelligent Investor Equity Growth portfolio. It invests in very similar stocks to the equity income portfolio. The only difference between the two, say for example, the equity growth portfolio invests in a handful of stocks that don't actually pay any dividends because they're very much growth orientated stocks. So of course they don't make it into the equity income portfolio. So both portfolios managed by the Intelligent Investor team. Will state as well there is no performance fees associated with those two portfolios, and they come as a separately managed account. And finally here we've got the core growth portfolio, which is a blend across different asset classes. So within that you've got ASX 200 exposure through an ETF. You've got international exposure through a range of ETFs. You then have a bit of property exposure as well. And then you have a little bit of cash and fixed interest exposure, all done through exchange traded funds. And of course, there's no performance fee associated with that one either. So that's now brought me to the end of the formal part of this presentation. So what I'm going to do now is just jump off the PowerPoint here and go to the questions to see if any have come through. And this question actually was already up before the presentation started, and it's from Martin, and it's a really good question. I'm well over 40, but I have been giving some advice to my niece who is in her 20s. One thing that surprised me is her high aversion to risk. My thought is that at her age, she should have some tolerance for risk, but she hates the idea of her investments going backwards at all. How can I best explain to her that this part of investing and inevitable, that this is part of investing and inevitable if you want a good rate of return? Really good question, David. Now, I think there's two things to look at here. Is one, maybe look at why they might be investing or why they would be saving. And of course, a lot of people maybe in their 20s and 30s are looking to save for a house, or looking to save for holidays, cars, etc. So some of those, say as a house deposit, some of these things are more of a shorter term goal, and hence the risk, the aversion to taking higher risk. But I definitely agree that a portion of people, a portion of your earnings when you're in your 20s and 30s should be going into say, a long-term investment like the stock market. How you can actually talk to her about it, it is very difficult, but perhaps like just look at sitting back and showing her some charts like I did, that long chart there of the ASX 200. That was just the price index. So if we also added on top of that the accumulation index, where we're showing the dividends that are reinvested, well, it's that would be, I guess, pretty compelling to someone a bit younger. So I hope I've answered your question there. It's a tricky one, but you need to maybe sit down and find out what she's investing or saving for. And of course, if it is certainly for something like a home deposit, etc., which a lot of young people are, looking to save for, and the higher, of course, those house prices get, the further away the reality of that appears to be for a lot of younger people. And so, of course, if any form of risk that you take or any setback that you have is quite disheartening. So I can understand why there is the aversion to risk. But perhaps sit her down with some of these charts of, like, say, some managed funds that have done well for yourself, or some exchange traded funds as well, and just talk to her about the actual mechanics of them. And and also though use professionals as well. You can we've got a team that people can call up and have a chat to, and we do have quite a number of younger subscribers. And I think once they just become more comfortable and more educated around the investment process, then they will be feeling much more comfortable to go into those higher risk categories. Nicole asks, will the slides be available again? Yes, the slides for this presentation, Nicole, will be available, and I will email them to you straight after this, as well as the ones that you asked for from the previous one. You'll get both of those slides just straight after this. Nick asks, what is the minimum amount I can invest for a newborn? Well, with us, Nick, the minimum investment has been increased to $10,000 for a separately managed account. Now, if you are looking outside of us, I mean, there is no real minimum. I mean, CommSec recently have decreased their brokerage rate for parcels under $1,000. I think they're charging just $10. So you can invest under $1,000 if you are looking to buy direct equity. So that might help you out. With us, it is the minimum investment's $10,000. That's for a full separately managed account. But stay tuned there as well. We are developing new products all the time when it comes to investing. We perhaps can have one which with a smaller entry level. We've got another one here from Justine. Best set up for grandchildren who range in ages between 2 and 6 and 17 and 20, while looking after our own aging needs, and am quite risk adverse. That's very specific, so I can't give you any real specific advice there. I don't know your personal circumstances. I would say to go and talk with your accountant and or advisor. When you say you're quite risk adverse, if it is over the long period of time, perhaps something more like the InvestSMART diversified core growth portfolio, because you are investing in exchange traded funds. There are so many different stocks across exchanges and across different asset classes as well. So you are taking out that specific company risk. You've got, of course, market risk, because say when it comes to the ASX 200, you're buying all 200 companies. But with the actual market risk, company risk, by holding 200, you are taking that away. David asks, can I view each of my children's investments online individually? Most notably, if I was deciding to invest in different models based on their ages. David, yes, you can. With us, most definitely. I can't speak for other providers, of course, but with us, we can set up as many different accounts as you invest in. within your InvestSMART view. So you can see that if you've got 4 different kids and you've got 4 investments for them, all in different separately managed accounts, then you can definitely see a breakdown of those individual ones. That's no problems at all. Joe asks, what's the difference between the 14.28% and the 3.9% on the income portfolio? Joe, I believe the 14.28% that you're referring to is the total return. So that's capital growth and income received, so dividends received. The 3.9% is just the income received. So that's the estimated yield going forward on that portfolio. So 3.9% is what we expect to get as income from the companies that we hold as a part of that portfolio. The 14% that you mentioned is a total return figure. And Nicole asks, and it looks like our last question, so I will wrap it up after this. Are the InvestSMART core growth funds, etc., managed funds? The core growth fund and all the funds, everything that we currently offer is run as a separately managed account. So unlike a managed fund where you'd go into the one pooled investment with everyone else, the separately managed account, you've got your own account set up there and we buy shares in it for you specifically. But yes, we do manage those shares. So when we go out and buy 25 odd stocks in the Intelligent Investor Equity Income portfolio, we're actually buying all those 20 odd stocks just specifically for you. But when we change that model portfolio, your holdings will also change. Okay, so just like a managed fund, when the underlying holdings change, when a manager decides to sell or buy a stock, the same thing will happen in your portfolio. So think of it like a managed fund, but it's a separately managed account, which means you get greater transparency where you can see every single stock and you actually have the beneficial ownership. So you get to see every single stock, all the income coming through. There's nowhere to hide with a separately managed account, as opposed to a managed fund where it's all in the one pooled investment and you will, generally speaking, only get to see the top 10 holdings once a month. So I hope that answers your question there, Nicole. Now, that brings me to the end of our presentation here, but thank you all for joining us, and I hope to catch you next time. Cheers.